If you're watching silver prices, you're late. If you're watching flows, you're early. Something flipped overnight, not price. Policy and positioning. China just tightened export language on silver compounds. JPMorgan's futures footprint reversed from habitually short to structurally long. Industrial pull accelerated. Solar, EVs, data centers grinding through supply. COMEX registered stocks started draining one direction. And the chart? Calm. That's the tell. When paper markets stay quiet while physical plumbing grinds, you're not watching confusion. You're watching a valve system. Pressure builds where you can't see it. Price discovery gets delayed, not canceled. If you're holding silver, stacking it, or just watching the sector, this matters now. Your job isn't to predict the exact move. It's to understand the structure before it shifts visibly. We're going to show you 2 repeatable patterns that explain what's happening under the surface and give you 5 signals to track this week. Stay close. Before we go further, subscribe if you want this kind of breakdown every week. We track the flows others ignore while headlines chase noise. Drop a comment with flow if you're already watching the plumbing, not just the price. Let's get into it. Here's what moved. China's Ministry of Commerce revised export protocols on silver-based compounds mid-January. Not a ban, tightening. That matters because China supplies roughly a quarter of global refined silver. Any friction there shows up as delays, premiums, and restocking urgency downstream. At the same time, industrial demand isn't slowing. Solar panel manufacturers pulled record volumes last quarter. EV production is stabilizing at elevated levels. AI infrastructure, data centers, cooling systems, connectivity hardware needs silver, lots of it. And then there's the positioning shift. JPMorgan Chase & Co. Torusit, historically the largest short-side participant in COMEX silver futures, flipped, not a small trade, a structural reversal. They've moved from suppressing volatility to holding length. That doesn't happen on a hunch. But here's the part most people miss. Price hasn't screamed yet. It drifted slightly higher, then settled. Futures volume looks normal. Headlines barely noticed. That's the hidden layer. Because while the surface stayed calm, 3 things started breaking underneath. Lease rates lifted, warehouse stocks began flowing one direction only, and physical premiums, coins, bars, deliverable forms, stayed persistently elevated. Those don't game easily. Think about that. Price can be managed, volatility can be dampened, but you can't fake a lease rate spike or persistent physical premiums without real stress in the system. So the question isn't whether something is happening, it's whether you're watching the right signals to see it early. Let me show you the first pattern. I call it the Drain-and-Dampen Cycle. Here's how it works. Think of the silver market as 2 systems, paper and physical. Paper markets, futures, options, ETFs, are the valve. They relieve pressure. When demand surges or supply tightens, paper liquidity absorbs the shock. Prices can drift, but volatility stays contained. It looks calm because the valve is open. Meanwhile, physical metal quietly drains. Big players accumulate deliverable silver bars, coins, allocated accounts. They pull it out of circulation, not all at once, steadily. Registered COMEX stocks drop. Eligible inventory sits but doesn't replenish. Lease rates, what it costs to borrow physical silver for short periods, start ticking up. The valve stays open. The drain continues. This cycle repeats across metals and energy markets. It's not new, it's structural. Why does it repeat? Incentives. Large institutions need to manage balance sheets without triggering disorderly moves. They can't afford a squeeze that spikes volatility, torches derivatives books, or forces margin calls across portfolios. So they dampen paper while accumulating physical. Liquidity providers suppress volatility to protect infrastructure. Accumulators extract metal to position for the eventual repricing. Both can be true at the same time. Now apply this to today. China tightens exports, physical supply constrained. Industrial demand accelerates, physical demand elevated. JPMorgan flips positioning, formerly dampening, now long. COMEX registered silver has been drawing down steadily, not catastrophically, just persistently. One direction. Eligible stocks aren't converting to registered at the rate you'd expect if supply were abundant. Lease rates, normally flat, boring, barely worth checking, have started lifting. Small moves, but consistent. Physical premiums on coins and bars haven't collapsed back to spot. They're holding. That's the tell. If this were just demand, price would already be higher. But it's not just demand, it's structure. The valve is still open. Futures liquidity, options markets, ETF creation, so price discovery gets delayed. Paper absorbs the signal. Physical drains anyway. This is the drain-and-dampen cycle. You've seen it before in other markets. Palladium in 2019, nickel before the 2022 event, even oil during certain OPEC cycles. The pattern. Accumulation happens quietly under a calm surface. Then inventories thin past a threshold. The valve can't relieve pressure anymore. Price discovery snaps back. not telling you silver is about to snap, showing you the structure that precedes it. Your job is to recognize the cycle, not predict the exact timing. Circle this. When physical drains while paper stays calm, you're not watching stability. You're watching a lagged system. The question isn't if pressure builds, it's when the valve stops working. Now let's connect this to the second pattern, the position flip signal. Here's what makes this different. A trade is temporary. A position flip is structural. When a large participant, especially one historically positioned short, reverses to long, it's not a bet on a price move. It's a recalibration of systemic exposure. Think about why that matters. If you're short silver futures, you're betting price stays contained or drops. You're supplying liquidity. You're the counterparty absorbing long interest. You dampen volatility because your positioning acts as a release valve when speculative interest surges. But when you flip long, you've stopped being the valve. Now you're competing for physical. You're adding to demand-side pressure instead of relieving it. The market loses a stabilizer and gains a participant pulling the same direction as everyone else. That's not a trade. That's a regime change. Imagine you're running a trading desk. You've been structurally short silver for years. It's a liquidity provision strategy. You hedge with physical holdings, warehouse access, and ETF positions. You manage volatility risk. You profit from spread relationships and contango. Then something shifts. Maybe your risk models flag physical tightness. Maybe warehouse data shows draws accelerating. Maybe lease rates signal that rolling short positions forward is getting expensive. Maybe export restrictions or industrial demand forecasts change your medium-term outlook. You don't just reduce the short, you flip. Because if the system is shifting from abundant liquidity to constrained supply, staying short is no longer profitable, it's dangerous. And if you're flipping, others are watching. They know what your positioning means. They know your historical footprint. They know your reversal signals confidence and tightness, not just opportunism. So they adjust too, not all at once, but directionally. The last time this flipped in a major commodity, the move didn't start on the chart. It started in warehouse data, lease rates, and positioning reports, months before price reflected it. That's the position flip signal. It's not a prediction, it's a structural marker. Could it reverse? Of course. Markets are dynamic. New supply could emerge. Demand could collapse. Policy could shift. Nothing is guaranteed. But here's what you need to sit with. When a dominant liquidity provider stops fighting price and starts positioning for a move, the probability distribution changes. The baseline scenario, where price stays range-bound and volatility stays low, becomes less stable. Two scenarios become more likely. One is orderly repricing. Lease rates creep higher. Physical premiums persist. Registered stocks draw steadily. Price adjusts gradually as arbitrage closes the gap between paper and physical. Volatility stays manageable. Holders benefit. Late entrants pay higher premiums, but still access supply. The other is a disorderly snap. Export restrictions accelerate. A derivatives book blows up. A large holder demands physical delivery against a stretched system. Lease rates spike. Premiums explode. Paper markets freeze or gap. Price discovery happens violently. Early holders win big. Late entrants face scarcity or locked markets. Which one happens? Can't know. But the mechanics that precede both are the same. Physical drains, liquidity thins, positioning flips. If you're watching now, you're ahead of the crowd still checking daily price charts and wondering why nothing is happening. Something is happening. You're just looking at the wrong layer. Here's what you need to sit with. The question isn't, will silver move? The question is, how does price discovery return? Because price discovery didn't disappear. It got delayed. Paper markets absorbed the signal while physical kept draining. The valve system worked until it couldn't anymore. Now we're at the inflection point. Physical supply is constrained. Positioning flipped. Industrial demand isn't slowing. Lease rates are lifting. Premiums aren't collapsing. The structure has already changed. Price just hasn't caught up yet. And here's the part that matters to you. Wealth transfers during these moments favor the group watching flows, not the group watching headlines. If you're still checking silver's spot price every morning and wondering when something will happen, you're late. If you're tracking warehouse data, lease rates, and positioning shifts, you're early. That gap between what's visible on the chart and what's stressed in the plumbing is where the opportunity lives. Not telling you to buy, not predicting the exact move, showing you the structure so you can make your own decisions from an informed position. So what are the exact tells that confirm we're past the point of no return? That's next. Let's talk scenarios. 3 paths forward, and the signals that tell you which one is unfolding. The first path is orderly repricing. Lease rates creep higher steadily, not spiking, just grinding up. COMEX registered stocks draw down week after week. Physical premiums stay elevated but stable. Price adjusts upward gradually. No gaps, no panic, just a slow grind. Who wins? Holders who bought early. Stackers who accumulated before premiums widened. Traders who respect the trend and don't fight it. Who loses? Late entrants who wait for confirmation and pay higher premiums. Shorts who stay stubborn. Signals to watch: persistent lease rate elevation. Steady registered stock declines. Premiums holding or widening slightly. CFTC data showing commercials reducing shorts. The second path is squeeze-lite. Premiums on physical silver persist at elevated levels for weeks. Registered COMEX stocks slip below psychological thresholds, maybe under 50 million ounces. Lease rates spike briefly, then settle higher. Futures markets stay liquid, but physical delivery tightens. Some buyers face delays or allocation limits. Who wins? Early holders, those willing to hold through volatility. Participants who secured physical before tightness. Who loses? Paper-only positions that can't convert to physical. Late buyers facing allocation limits. Those who panic sell during brief corrections. Signals to watch: sharp lease rate moves followed by elevated baseline. Registered stocks breaking key levels. Delivery delays showing up anecdotally. Premiums widening persistently. The third path is the snap. Export restrictions accelerate. China, Mexico, or other suppliers tighten further. A large participant demands physical delivery against a stretched system. Lease rates explode. Premiums double or triple. Futures markets gap or freeze temporarily. Price discovery happens violently. Media finally notices. Who wins? Those holding physical before the snap. Participants positioned early with size. Who loses? Everyone else. Late entrants face scarcity or locked markets. Paper positions that can't settle physically. Retail buyers priced out entirely. Signals to watch: sudden export policy changes. Lease rate spikes above 10 to 20%. Registered stocks collapsing rapidly. Futures volume surging with poor liquidity. Media attention spiking. Now let me tell you what I'm tracking this week. Not predictions, just my watch list. First signal is COMEX registered versus eligible silver. Normal behavior means registered stocks fluctuate but trend stable. Eligible converts to registered when demand rises. Stress behavior means registered draws persistently. Eligible sits without converting. One-way flow. What it means: physical is being removed, not rotated. Supply isn't abundant. Second signal is silver lease rates. Normal means flat, boring, near zero. Stress means small upticks, then persistence at elevated levels. Spikes above 1 to 2% signal tightness. What it means: borrowing physical for short positions is getting expensive. Shorts are under pressure. Third signal is physical premiums on coins and bars. Normal means close to spot with small fluctuations based on retail demand. Stress means premiums persist at 10-20% or higher above spot and don't collapse on dips. What it means: physical supply is tight relative to demand. Paper and physical are diverging. Fourth signal is CFTC positioning shifts. Normal means commercials net short. Speculators net long with stable ratios. Stress means commercials reducing shorts or adding length while managed money increases longs. What it means: smart money is repositioning. Liquidity providers see tightness. Fifth signal is China export headlines. Normal means routine statements with no restrictions. Stress means any language around tightening, quotas, or strategic reserves. What it means: supply-side constraint is real and accelerating. Now let me talk about what could break this, because we can't know the future, only structure. First risk is liquidity injection. Central banks ease policy unexpectedly. Dollar weakens sharply. Financial stress eases. Silver rally stalls as macro shifts. Second risk is policy whiplash. China reverses export restrictions. New supply sources emerge quickly. Physical tightness eases faster than expected. Third risk is paper physical divergence. Futures markets stay liquid while physical tightens. Price discovery stays delayed longer than expected. Patience required. Fourth risk is sentiment traps. Price spikes, media hypes, retail rushes in, then corrects sharply. Weak hands get shaken. Pattern still intact but emotionally brutal. Fifth risk is timing risk. Structure is right, but timing is unknown. Could take weeks, months, or longer. Opportunity cost of waiting. Sixth risk is demand collapse. Recession hits harder than expected. Industrial demand craters. Silver falls despite tight supply. Let me tell you how I'm approaching this. Not advice. Just my framework. I'm watching flows, not price. I'm tracking the signals above weekly. I'm respecting that timing is unknown but structure is clear. I'm holding physical exposure but not over-leveraged. I'm prepared for volatility and false starts. If you're a trader, respect the volatility and manage position size accordingly. If you're a holder, accept that the path might include sharp pullbacks before the structure resolves. If you're watching from the sidelines, use this as pattern practice. Learn to spot these cycles early so you're ready next time, whether it's silver, another metal, or a different market entirely. Your job isn't to predict, it's to understand the structure and position accordingly. Here's the bottom line. Silver's structure shifted, physical supply tightened, positioning flipped, industrial demand accelerated, lease rates lifted, premiums persisted, price stayed calm. That's not stability. That's a lag system. The drain-and-dampen cycle is playing out. The position flip signal confirmed. The valve system is losing effectiveness. Price discovery didn't vanish. It got delayed. And when it returns, orderly, squeeze-lite, or snap, it rewards the group that was watching flows instead of noise. If you tracked warehouse data, lease rates, positioning shifts, and physical premiums, you're in that group. If you waited for headlines and chart confirmation, you're behind. Not telling you what to do, showing you what to watch. Your decisions are yours, but they should be informed. So here's my ask. Drop a comment. Binary question. Are you watching paper calm or physical stress? If you spotted a premium anomaly or lease rate move this week, share it. Let's build the watch list together. Subscribe if you want this breakdown every week. We track the patterns others ignore. And share this with someone who's still checking daily price charts, wondering when silver will move. Show them the layer underneath. Quick recap. Pattern 1 is the drain-and-dampen cycle, where physical drains while paper stays calm and pressure builds invisibly. Pattern 2 is the position flip signal, where when a structural short becomes structurally long, it's a regime change, not a trade. The watch list includes COMEX stocks, lease rates, physical premiums, CFTC positioning, and China export language. 3 scenarios to watch for: orderly repricing, squeeze-lite, or snap. Signals tell you which path is unfolding. And remember the risk cluster. Stay humble. Markets are dynamic. Structure can shift. Final insight. Price follows plumbing. If you watch the pipes while others watch the price, you move earlier, you position better. You don't get shaken when volatility hits because you understood the structure before it broke. That's the edge, not prediction. Pattern recognition, not guarantees. Informed positioning, not hype. Reality. Links in the description for the CFTC reports, COMEX data, and lease rate trackers we mentioned. Stay sharp, stay disciplined, stay ahead. We'll see you next week.